And welcome to the AM video edition of Traders Espresso for Thursday, March 8th, 2018. The written edition has been published, and basically I think that markets have shrugged off trade war fears, Gary Cohn's resignation, all of that. And I'm going to just cut to the chase. I think the markets are becoming comfortable with the idea of headwinds. Headwinds like rate increases and inflation, headwinds like trade wars, in the face of the fact that we have an economy, both globally and domestically, that continues to be strong. Corporate earnings are strong. The fear is the economy overheating, leading to inflation. If rates, a measured rate increase keeps that in check, then so much the better, because we don't have rampant inflation to deal with and have to increase rates on a tighter schedule, which could potentially derail the economy. Headwind or trade wars would also be seen as a headwind. So it's almost like, and this is my observation that I made in the written blog, is it's almost like President Trump has created the perfect storm with corporate earnings that were already strong. I mean, he takes credit for the market, but it was already in place. But then the expansionary fiscal policies that his administration has implemented in terms of increasing the deficit and through tax cuts and things of that nature, that he has the luxury to throw the U.S.'s weight around and negotiate better trade deals to put America first, on a multilateral basis, through NAFTA, through possibly maybe revisiting TPP, but negotiating a better TPP for the U.S., or negotiating better trade terms with the European Union or with China, whatever the case may be. We'll see how successful he is in that, but at least that's where I think his thinking is right now. And I think markets see that. I have no way to prove it. I just think that's what markets see, and they're comfortable with it. And markets have supported the Trump administration since the day after his election, so that's kind of where we stand. In terms of the futures markets themselves, I mean, it's interesting because on the news that Gary Cohn was resigning, markets gapped down, and basically equities markets gapped down and then basically traded up to fill that gap. And I'm going to show you some examples here with the S&P as an example of a market that gapped down. Copper gapped down too, as well as the markets that gapped up, which would be gold and the Japanese yen, because gold and the Japanese yen are flight to safety plays. And if the markets gapped down, there was an exit out of equities and into safer assets like the yen and gold. So markets gapped down. This is the gap right here, and then traded up to fill that gap, and then closed. The S&P closed below it, barely below it. The Dow closed below it as well. The NASDAQ futures and the Russell futures actually posted gains on the day. But you can see now here overnight and going into, leading up to the regular session, that the S&P is trading higher. It's up 40 basis points right now, 0.4%. So we're starting to see a bearish stochastic crossover on the day. Oh wait, that's not, I'm sorry, that's a 15-minute chart. Let me look at a day chart here. I was getting confused. I was looking at a day chart. But we are seeing the same thing. The point I was about to make was we saw a bearish stochastic crossover on the day chart on the 1st of the month. We're now seeing that temper and potentially positioning itself towards a bullish crossover back to the upside, which enables the market to drive back up to its high, most recent high, which was set on the 27th. and then from there even further to the high that was set here on the 29th of the month. If you look at the week, the week has been kind of up and down, still bearish overall, but softening a little bit. The month is still forming. So we had a bullish stochastic crossover or bearish stochastic crossover when we closed February, and that histogram is increasing to the downside. But you can see this is March. March still has a way to go to get to the highs of February and even to the highs of January. All right. If we look at gold, that's one of the flight to safety plays. Okay, I don't know. There was a trend line there, but whatever. You can see here gold gapped up and then quickly filled the gap. So what's interesting about that is not only did it fill that gap, but it traded down significantly below it, almost closing at the lows of the day. So it's almost like gold isn't even really considered a flight to safety. I mean, this sell-off is just disproportionate compared to the melt-up that we saw in equities. So that one's still kind of a head scratcher for me. The other one that I talked about that we can take a look at is the Japanese yen. The Japanese yen gapped up, but then it took a little bit longer before it closed that gap. It was almost it was just before lunch, so it was almost halfway through the day before it was able to close that gap. And then it traded up a little bit, traded down, and now the yen is down on the day 8 basis points. So at least the yen behaved a little bit more like you would expect it to. The gold, that one's very puzzling to me. And gold really hasn't been acting as a safety measure, as a safety play for quite some time now. This is not the first time I've made this observation. But the Japanese yen, and also probably the Swiss franc, which is another flight to safety currency, still seem to be acting like you'd expect them to, in the face of upsetting headlines, headlines that upset the market. Now what's interesting here is how far down the Swiss franc has traded below even the gap. It's down 35 basis points compared to yesterday's close. So looks like the market just opened. This Trader's Espresso ran a little bit long, but I'm going to go ahead and cut the stream, and I will jump back on the live stream